This is my second consultation call with Trade Brigade, and it's day trading knockouts here, guys. And in this episode, this is part one. This is episode two, part one of my new series that I'm making. And in this video, Trade Brigade is going to be teaching us specifically about Jerome Powell and his effects on the market, especially on the days that he speaks. Jerome Powell, in a way, in case you don't know, is like this omnipotent being that has lots of sway and influence in the stock market. So it's important for you to know how to handle those specific days when he has a speech, regardless of whether you do decide to trade on those days or you just avoid it completely. You got to make that decision for yourself and decide what works best for you and your strategy. Now, me personally, in my 2 years of experience, I've had my fair share of headaches from the news influence Jerome Powell days. So in this video, I want to be able to help all of you fellow traders, regardless of where you are in your career, from the beginner, intermediate to advanced stages, either to give you insight or steps to be able to better your trading career to handle these specific days. And so with that being said, that's all I got to say for the introduction. Don't forget to like and subscribe to Day Trading Knockouts. Stay safe, stay green. Let's get into the video. Peace out, my fellow day trading millionaires. Sorry, billionaires.
Jerome Powell. And I'll make a couple of general comments about Powell. First and foremost, like, the market's always going to react as a wild card to most things that he says. There's never one good way to say for sure, like, okay, when Jerome Powell says this, the market should do that. And the reason being is the market's constantly in a flux between wanting higher interest rates and wanting lower interest rates, wanting expecting cuts in the future, which would be bullish for certain reasons, right? Rate cuts in the future could be bullish because it would imply that the tech space, specifically the XLK, right, because we know it represents the most heavy weight of the S&P, specifically, lower rate environment favors technology companies because of the way that their margins work, right? In the future, their cost to borrow money, because a lot of, all of these companies basically take massive loans to develop. That way they can deploy their cash to, number one, building inventory, right? If you think about any company that's flush with cash, Apple is probably the best one that comes to mind, right? They want to have money on hand to do payroll, of course, buy inventory, have product in store, research and development, and they want to be able to jump on any opportunity. So the idea is that all of these, like, any large company is not paying for everything in cash, but they need the cash on hand to secure a loan, so to speak, if an opportunity comes up. So lower interest rate environments would favor a company like a tech company. And being the heaviest weighted component of the S&P, typically we would think that when Jerome Powell is more dovish, which would imply lower rate environments, easier monetary policy, we would expect positive things out of the XLK, which in turn would influence the S&P to move higher. So that's roughly one relationship. And obviously the inverse would be true as well. As rates continue to move higher, it puts more pressure on the tech sector because, it costs more money to borrow money, basically, and therefore their margins go down, their profit margins, that is, and the company becomes, quote unquote, less valuable on the book, even though nothing has really changed in the operation. It's just that the cost to borrow money is much higher. And that's seen as obviously a bearish indication. So you would expect the market to move lower. Now that's one environment. And the tricky thing about Jerome Powell, the tricky thing about the Fed is that there are really a number of environments, right? Because that relationship that we've just described here is holding everything else equal. It's assuming that nothing's really wrong with consumer spending. There's no issues with unemployment. There's no issues with all of the other economic indicators that we look at. In a vacuum, if that's the case, then we would say, okay, economy's fine, lower rates are good for the economy. What we're heading into now, and this is not 100% my expertise. This is my understanding of it. So I don't want, basically what I'm saying here is I don't want anybody to panic and assume that a big recession is around the corner and the market's going to go to zero and all that stuff. But it certainly seems as though the way the market's acting, it's getting fairly concerned about a potential recession in the future. And the reason I would say something like that is because, as we're on the cusp of potentially seeing rate cuts in the future, it's actually having more of a bearish connotation for markets, right? As Jerome Powell changed his stance to say something, in the last meeting, the FOMC, which is, I'm assuming, the day in question here. But this is the FOMC day from 2 Wednesdays ago, not this past Wednesday, but the Wednesday before. The market moved lower after he was pretty clear about saying, hey, we're going to take our foot off the gas and not necessarily hike rates. Because the assumption is, as rates continue to go up, it's not so much about hurting the tech sector anymore. It's about breaking things in the economy, aka huge levels of unemployment. It's about, as you've seen in the headlines, I'm sure the banks are blowing up and there's interest rate risk in terms of long dated securities that these banks may have picked up that are now underwater. So the systemic risk now makes it so that, okay, if we're cutting rates here, it's not because everything's fine and healthy in the economy, and it's not likely that companies will just recover so easily in a lower rate environment like the tech sector. Now, all of a sudden, the rate cut has the implication that, hey, the Fed needs to step in and stop things from breaking. The consumer is not healthy. There are layoffs. Spending is down. And if all of these things are true, then we're not in a situation number one. We're in a situation number two, kind of headed for a recessionary type theme, where as earnings compress, obviously it means that valuations of companies have to compress, not just because interest rates are higher and the cost to borrow money is also higher. So those two themes kind of compete with one another as the market's trying to figure out what's taking place. And I think we're kind of like in between themes right now, because if you've been watching the numbers, sure, we had this recessionary type reaction to what Powell said about potentially pausing, but the unemployment rate is still historically record low. Consumer spending seems to be holding up based on the PCE, and even just like if you look at retail sales reports, it's down in particular areas, but it's not like everything's been wiped out. So the market's kind of caught between two themes, like the I'm sure you hear the term soft landing. Soft landing would be the number one situation that we just described, where rates can come down, off of these higher levels. Companies' earnings remain intact, consumer remains intact, and all of the economic indicators that we watch, PCE, like inflation comes down in this situation. Unemployment remains relatively low. Consumer spending is still elevated. That's a situation number one, which would be seemingly difficult to pull off. That's why everybody's talking about soft landing is going to be impossible. Get ready for a bumpy ride, this, that, the other thing. I don't think it's completely off the table. I do think that it might be a little bit more difficult to achieve than potentially earlier. And then number two is the recessionary theme, which is unemployment does rise, consumer spending contracts, interest rates do come down, inflation does come down, but it's at the cost of these other economic indicators. And when earnings come down, obviously we know the market has to come down a little bit. So that would be more of a hard landing, a bumpy ride, something that's not great. Now, the worst situation that we could potentially get caught in is door number three, which hangs out over here, which is unfortunately what happened in the 1970s, which is stagflation. And stagflation is when interest rates come down, but inflation remains high, unemployment goes high, consumer spending drops, and you can imagine that this is like the perfect storm for really bad things to happen in the marketplace, where there's a large flush and then the market goes sideways for a long time as we just try to recover. Now, all of these, let's be very clear, like all of these are very macro level themes, meaning that they're very, none of this plays out in one day, right? This takes a long time to unfold. Like if I go to I just want to show you the period of the 70s so you can kind of get the gist of what I'm talking about here. right? This is what they called the lost decade, because the market literally did nothing for 10 years roughly. Here's the 70s, right? It went completely sideways for 10 years, which sucked. Yeah, I mean, look at this thing, just brutal over here.
Yeah, I could see that when you put it on the max available timeline, it was just flat and then it just skyrocketed.
Yeah. So that's a positive, right? I mean, I'm assuming you're a fairly young guy, right? You're not
I'm pretty young.
You're not retiring tomorrow, so
no, not even in probably the next 30, 40 years.
Yeah, exactly. I'm in the same boat. I'm getting into my upper 20s, but for the most part, I've got a pretty long time horizon, and this to me represents an opportunity, right? Because we're young enough where we have time. We can wait. We can be patient. Now, I'm not advocating that you drop every last dollar into the market and wait 50 years to enjoy your money. That's you've got to have some personal fun. You've got to have some reserve money. I think real estate's always going to be a great opportunity just because of the tax advantages and leverage that's there. So I'm not advocating for drop every dollar in here, but you can see obviously that there's an opportunity, because on the back end of this, obviously as things resolve, you typically see a big expansionary type phase in the market, right?
Okay,
And
yeah.
we know historically, the markets have only done one thing since their inception. They've gone up, right?
Yeah.
So,
sorry, can you hear a bunch of talking in the back?
It's very, very quiet. Like I can hear some like faint sounds like they're in 10 office rooms down the hallway. It's no big deal.
Okay, I just wanted to make sure.
Yep, no problem. So that's the macro point of view of what's potentially taking place here. Now, again, I don't want you to take this and say, okay, let's short the market early next. And I'm not saying you're going to do this. Obviously, I know you're much wiser than that, but these things take time to play out. It's just the themes of the market, but it all comes back to basically how we sort of think about Jerome Powell. Let's go. Oops, we want to go back to the ES. It goes back to how we think about Jerome Powell and what he potentially implies for our markets. I'm just going to get 10. And where is that day? It's back here. There it is. And so I would say that now that we've established sort of this like base understanding, that's the fundamental take. The technical take is usually that you just want to be prepared for volatility whenever he starts opening his mouth. Typically, I close all my positions here before the FOMC is always at 2 p.m. on a Wednesday. It's usually every month, unless there's no Fed meeting, which there's none in April. There will be one on May 3rd. That's the next upcoming meeting from the Fed, or at least FOMC announcement, I should say. So I'm flat, right? I'm not interested in any of this price action in here, just because I think the volatility is too much. Now, as it's unfolding, I don't think it's worth positioning ahead of time for a potential move here or here. But as it's unfolding, when we start hitting really extreme levels or structural areas of importance, I think it's reasonable to take small scalps in that area. And there's two responsible ways to do it. I would say number one would be using something like SPY or SPX, whatever. You could even use QQQ. You could use whatever index you prefer, but do so with a position that's sized for zero, right? This has been a concept I've been talking about on the channel, the YouTube stuff for a little bit with the XLF breakdown. Is if you're going to do something risky, manage your risk completely by just assuming that as you enter the position, you will be completely wrong and you will lose everything. If you do that, then you will be resilient enough to hold through the volatility here. But also, you're not going to blow up your account on the trade, and you're not going to lose more than you expect to lose if you only put in what you're willing to lose in the first place, right? So that risk management portion of understanding the volatility and adjusting for that is probably a reasonable way to trade this. So as we get extended into particular levels, that's where you might go the other way. Now, Are you being a contrarian in that case? Are you typically fighting big volatility? Probably, but is there an opportunity to pick up, a quick dollar out of an SPX contract or 3 or 4 or 5 or however many, whatever you trade? Yeah, for sure. And if you can make, a quick $500, let's say you get $1 out of 5 contracts on the volatility in here, it's like, I'm not saying don't do that, but it's probably not a sustainable strategy whenever Powell is speaking. Just, he can say, all it takes is for him to spin his words in a particular way. And the next thing you know, the market completely reverses, right? In this case, obviously, we had big downside momentum. In here, I don't remember exactly what he said, but, whatever it was caused the market to sort of rally for a moment there before continuing. If you had a position sized for 0, maybe you were willing to hold through this. But for the most part, this probably made, because of the way volatility works, right? This probably made all of the IV get sucked out of the contracts momentarily. And if you were in puts, they probably went from, I don't know, I'm just making up a number. I don't recall exactly, but let's just say they were trading at $1 on the downside here. All this big downside momentum got them all pumped up. As this unfolded, they probably went to like 30 cents, right? So you're down 70% on this counter trend move, even if you entered like here, right? Just because the IV, the implied volatility on that particular contract, not only is the market volatile, but the implied volatility on the contract itself is also so volatile. So all of that's to say, like at the end of the day, there's no 100% guaranteed way of understanding how Jerome Powell will affect the market. Typically, when he says things that would imply lower interest rates in a normal environment, as we discussed, it should be bullish for stocks, for equities. As he talks about rising interest rates, it should technically be bearish. But as we navigate between theme number 1, where everything's fine and dandy, this is soft landing, and theme number 2, which is recession, then the market's going to interpret these two things in different ways. And obviously the degree at which they're interpreted, right? Because there's a big difference between obviously implying that, hey, maybe there's one more 0.25 rate hike in the pipeline, or maybe there's 3 25 basis point rate hikes in the pipeline, or maybe there's 0, we're pausing, or maybe we're going to go 50 basis point rate hike in the next meeting, and then we'll drop back down to 25, right? So there's degrees of how hawkish, right? Raising rates is hawkish, cutting rates is dovish. There's degrees of how hawkish or dovish Powell can be, and the market should respond accordingly. So a lot of moving parts, all of it's to say, usually it leads to a lot of volatility. As intraday traders, you just want to be super mindful of your levels, potentially get involved with position size for 0 at key structure, and just understand that you're playing with fire whenever he opens his mouth and starts speaking. So at the end of the day, that's the best explanation I could give to you. There's no hard and fast rule. Volatility is always a guarantee. The only guarantee is volatility, directionless in the volatility, just expecting wild action. Trade it responsibly, size for 0, or just avoid it at all costs and get ready for the next day, basically.
Okay, yeah.